My dad worked for 38 years. 38 years without missing a single day, without ever spending what he didn't have, without ever going into debt, on principle, out of pride, because that's how he was raised. He retired with $74,000. His boss retired at 54, with $4.6 million. The difference between these two men wasn't talent, wasn't intelligence, wasn't work ethic. My dad probably worked harder. The difference was that his boss understood something my dad never did, something they don't teach in school, something that wealthy people pass down to their kids in private, and that almost nobody else ever hears. He loved debt, not all of it, one specific kind, and this video is going to show you exactly which kind and why almost everything you've been taught about debt is at least halfway wrong. By the end of this video, you'll understand exactly how my dad's boss built $4.6 million using debt. Not in spite of it, because of it. There's an institution you've been dealing with since you were 18 that makes billions by making sure you never understand this distinction. I'll name it in part 3. I grew up in a house where debt was almost a source of shame, an admission of failure, and that conditioning followed me into my 30s. I avoided credit. I paid off overdrafts in a panic. I was proud of not owing anyone anything. And the whole time, people around me were getting wealthy. Not by working more, not by earning more, by thinking differently. It wasn't until I seriously studied personal finance that I understood the core problem. I'd been taught to avoid all debt without exception, as if a 24% credit card and a 3% mortgage were identical things. They are not, at all. And confusing the two, that's exactly the mistake most American families pass down from generation to generation, with the best intentions in the world. What if your fear of debt is costing you more than debt itself? We answer that completely with numbers. Before anything else, we need one foundation, a distinction most people never make. There are not many types of debt. There are two, and they are completely opposite in what they do to your financial life. You already know the first one, the 24% credit card balance for a vacation 2 years ago, the $40,000 truck financed over 72 months that lost 20% of its value the day you drove off the lot. What all of these have in common, they finance things that lose value or experiences that are already over. Money leaves your pocket every single month to pay for something that no longer exists. Bad debt is a wealth destruction machine running silently in the background 24 hours a day. And yes, you were right to avoid it, but here's the trap. Most people, after they've been burned by bad debt, conclude that all debt is the enemy. They swear it off completely. They feel virtuous about it. And in doing so, they accidentally cut themselves off from one of the most powerful wealth-building tools that has ever existed. This one, nobody talked to you about this one. Good debt is borrowed money used to acquire something that will be worth more tomorrow, or that generates income higher than the cost of the loan. Concrete example, you borrow $200,000 at 4% to buy a rental property. Annual cost of the debt, $8,000. The property generates $14,400 in rent. Net plus $6,400 in your favor. In 20 years, the property has appreciated, the mortgage is paid off, and you own an asset worth $300,000 or more that your tenant paid for. You didn't use your money to become a property owner. You used the bank's money. The rich don't avoid debt, they weaponize it. There's a difference, and that difference is the entire subject of this video. Good debt doesn't work alone. It combines with one other mechanism. When these two come together, the math becomes almost incomprehensible. Part 2. Wealthy people have one word for what they do with good debt. They call it leverage. And that single word captures the entire difference between building wealth slowly and building it at a speed most people find almost unfair. Here's the math. Raw, unfiltered. Scenario 1. No leverage. You have $50,000 in savings. Invest at 8% per year. End of year, $4,000 gain. Not bad, but not life-changing. Scenario 2. With leverage, same $50,000. Use it as a down payment to borrow $200,000 at 4.5%. You invest $250,000 total at the same 8% return. Gross result, $20,000. You repay $11,250 in interest. You keep $8,750 net, more than double. Same capital, same return rate, same time, more than double the result. That's leverage. You're not working harder. Your money is working harder because it's amplified by the bank's money. But here's the part nobody mentions. Leverage amplifies everything. Gains, yes, but also losses. There is one precise rule, just one, that every single person who has ever succeeded with good debt follows without exception. The golden rule, no exceptions. The return on the asset must always exceed the cost of the debt. Borrow at 4% to invest in something returning 7%. You're making 3% on money that isn't yours. Good debt in its purest form. Borrow at 24% to buy something that returns nothing. You're losing 24% on money that isn't yours. Bad debt at its worst. The sign between those two numbers, positive or negative, determines whether you're getting richer or poorer. That's it. That's the whole game. One rule, two numbers, one sign. Now, the promise I made at the beginning. The institution that makes billions every year by making sure you never understand this distinction. It's your bank. Wait, before you close the video, I'm not saying your banker is a crook, I'm saying something more disturbing than that. The business model of retail banking relies structurally on an information imbalance, and that imbalance is actively maintained. Your bank offers you a personal loan at 18% APR. It borrows that money from the Federal Reserve at 3%. It makes 15% on every dollar it lends you. At the same time, it offers you a savings account at 0.5%. It invests your deposits in assets returning 5 to 6%. Keeps the difference. Your bank uses exactly the same mechanism wealthy people use to get rich, except it uses it with your money against you. The rules that allow your bank to do this have always been available to individual people. They've never been illegal. They've never been restricted to institutions. They just haven't been taught. Before understanding this, you avoid all debt on principle. You keep savings in a 0.5% account. You watch others get rich and assume they had advantages you didn't. After understanding this, you make the distinction between the two types. You evaluate every loan through one question. Does the return exceed the cost? And you realize some of the greatest financial opportunities of your life require debt. Intelligently, intentionally, strategically. This isn't about courage, it's about information, and you now have the information. Back to the two men from the beginning. My dad and his boss. My dad lived a financially honest life. He saved, he was careful, he never risked what he didn't have. He did everything he was supposed to do. His boss did something different. At 34, he took out his first mortgage on a rental property, then a second. By 47, he had 6 properties, not one paid with his own money, all financed by rent, by leverage, by consistent application of the golden rule. He wasn't braver than my dad. He wasn't smarter. He just had one piece of information my dad never had. And now you have it. So what do you actually do with it? Step 1. Audit every debt you carry. List them. Write the interest rate and what it financed. Anything that financed a depreciating asset or a past experience, that's bad debt. Pay it off as fast as possible. Highest rate first. Kill the bad debt first. Then you can think clearly. Step 2. Learn to read a return before you borrow. For real estate, divide annual gross rent by purchase price. Above 5 to 6% gross yield in today's market. Worth studying seriously. Below that, the math is harder to make work. Step 3. Never confuse speed with recklessness. Leverage amplifies losses too. Always ask, can I survive the downside without losing the asset? If the answer is no, you're not ready, and that's not a judgment. That's math. I want to show you something most financial content never shows you. People talk constantly about the risk of using debt, about what can go wrong. Nobody talks about the risk of not using it, the guaranteed cost of staying on the sidelines. Person A, 30 years old, $50,000 in savings, never uses debt, invested in an index fund at 7% annual return. By age 50, $193,000. Not bad, solid, actually. But person A is still working, still trading time for money, still needs their job. Person B, same age, same $50,000, uses it as a down payment on a $250,000 rental at 4.5%. Rents for $1,800 per month, generates $200 positive cash flow after all costs. At year 5, uses accumulated equity to buy a second property. Repeats at year 9. By age 50, 3 properties, 2 fully paid off. Combined equity, $680,000. Monthly passive income, over $3,000. Same starting capital, same 20 years, completely different result. The difference isn't luck, isn't talent, it's one single decision. To understand debt rather than fear it. Inaction is not neutral, it's a financial decision. It just has a cost that's invisible and delayed instead of visible and immediate. The invisible, delayed cost is always the most dangerous because it never feels urgent until it's 20 years later. My dad is a good man, an honest man, a man who did exactly what he was told to do. That's the most painful part of this story. He didn't make mistakes. He followed the rules, every single rule he was given. The problem is he was given the wrong rules, or rather, incomplete rules, rules that protect against bad debt, but that say absolutely nothing about good debt. His boss didn't have different rules by nature. He just had access to one extra piece of information, that not all debt is the same. That conversation changed his financial trajectory forever. This video is that conversation for you. And what you do with it from here, that's entirely yours. Debt is not good or bad. It's neutral. Bad debt finances what disappears. Good debt finances what lasts and what grows. The question is no longer, should I avoid debt? The question is, does this debt finance an asset that generates more than it costs? If yes, study it seriously. If no, run from it fast. That's it. It's that simple, and that's what wealthy people have always known. Next video, in 2 days, I'm going to show you exactly how to calculate whether a rental property with a mortgage actually works. With real numbers, real expenses, real traps. I analyzed an actual deal someone sent me. A duplex in Austin, $320,000. Estimated rent, $2,400 a month. We run the numbers live and find out if it's a genuinely good investment or a disguised money pit. The answer will surprise you. Hit the bell. 2 days. If this changed something in how you see debt, send it to one person, someone you're thinking of right now. I'm John. Subscribe for a new video every other day, free, no fluff. See you in 2 days.